Please welcome President and CEO, Hunter Hotel Investment Conference, Teague Hunter, and the Main Street Talks panel.
Jump around, jump around, jump around, jump up and get down. Jump, 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 everybody jump, jump.
Woo! People still here. I like to see that. I like to see that. Let's do it. I like to see everybody still here. This has been a great first day, hasn't it? I'll applaud to that. And there's a good day tomorrow, too, just as a reminder. In the morning right here at 9 a.m. is Ed Bastian, CEO of Delta, and then the Hunter Award, Bob Hunter, and then Tony Capuano, CEO of Marriott. So that's a good morning to get us started off as well. A lot of good stuff. That was a great panel. Those guys are really smart. Are they smarter than we are? What are we missing? We're missing skinny blue ties and accents.
Yeah. And the difference is billions and millions.
Billions and millions.
Yeah. They lost me at that.
Did Shai say he was going to spend $2 billion and sell $2 billion? That's what I heard. That's what I heard. Mitch Patel at Vision, Al Patel at Baywood, Jimmy Merkel, Rockbridge, Greg Friedman, Peachtree. So we've got our two glorified owner-operators on the end and our private equity guys here on this end. Does that count?
That's right.
Great. Jimmy, what would you take away from that last panel? What'd you learn?
Well, they're really handsome, and
Very.
when they talk, you
Good-looking
just
group.
kind of feel like they know what they're talking about, right? You know, they could kind of say anything. And
Even if they don't.
yeah. So no.
Should we have worn like flannel and boots?
That's what I was thinking. We this is Main Street. Talks, right?
We should dumb
Yeah.
it down.
Yeah, so we're roll up your sleeves, folks. I think like many in the room. So I think it's always great to listen to what the big guys are doing, and I think they definitely are. And they said as much, that looking at big trends, and what we do is kind of on the ground. So hopefully we can do a few things and sell them some assets or aggregate some of our portfolio, and hopefully it's attractive to the bigger buyers out there.
Yeah, let's hope. Greg, what are you spending most of your time on today?
Yeah, so I mean, we're very busy on the credit side of the business. Really the last 18 months has been really challenging, going out and trying to buy assets or even trying to develop assets. As you know, it's tough to invest through the equity side, although we're doing more on the development side when we are investing equity today. But I would say by far we're investing a lot more on the credit side, where we're doing direct lending. We're also, actively buying a lot of loans as we speak right now. We bought a bunch of loans during the pandemic. And today, I would say, as we speak right now, by the end of this quarter, we should buy, at least a half dozen loans, if not more. So this quarter alone. So yeah, we're
Half a dozen loans you're going to buy this quarter.
That's right.
And that's new. You weren't buying that much last quarter.
Last quarter we bought 4 loans on different hotel assets. These are, first mortgage loans, and this quarter we'll at least buy 6 or 7 loans if I had to, guess, or if I had a crystal ball and got us to the end of the quarter. And I think, when you look this year, I think we'll be more active on the debt buying side. Like last year, we really didn't buy any paper until, the fourth quarter, so.
Interesting. Mitt said the same thing, but us average guys don't have that luxury. Jimmy, what are you spending most of your time on?
Yeah, so we do a little bit of everything. We've been writing some loans. In our fund, we do loans, we do acquisitions. As Greg said, it's hard to make the equity work. It's math at the end of the day. You've got 8.5%, 9% cost of capital conventionally, and then the banks want 12 debt yields, and then nobody wants to give up their property for a high cap rate. So it makes it challenging. But so you got to pick your spots, and so we've been always, it's in my blood to look at deals and do deals, so I always spend a lot of time on that. we're working on that. We're always fundraising as well.
How is the fundraising? Especially if it's hard to put money out, how's the fundraising?
Fundraising is actually pretty good. We're not trying to, raise a lot more money. Our funds are, in the mid 400s, and if we have a large deal, we'll co-invest, which our investors like, and so it enables us to, size right and not have too much money under management that has to go out in a certain vintage, and when you're in the business long enough, vintage does matter. It really does when you do deals. I mean, there are deals that are great deals that we did in 2017, 18, but they're not going to be great investments because they had to live through COVID and the downturn of cash flows. But they're still good deals, and so those vintage funds matter. So we're always fundraising, we're always looking for deals, and I think the hard part and what investors, at least on the institutional side, are looking for is the turnover of investments, and that's what is also important. And when Shai said, he's going to sell $2 billion and do $2 billion, our numbers are material, but not that big. But we're going to do the same because we are always buying and selling assets, and that's what we look to do to return capital to our investors.
How many hotels will you buy this year, and how many will you sell?
We're kind of geared to do 10 to 15 hotels a year, and if we sold 10 to 15, we'd be very happy.
You think it'll be even on buy and sell, or you think?
I don't know. I mean, that's the best I can say. I mean, this is an imperfect. It's not like we can go to the stock market and buy shares at whatever price. You got to have willing buyers and sellers. So it's always, always hard. One of the things that we have as a focus is control the things that you can control, and the things that we can control what we do, and we can also control, do we have the best team in place? Do we have the best strategy? Are we executing and driving cash flow as best we can? And those are the things that we have some control over. You can't manufacture revenues, but we're human. We're always doing things not as well as we could be. So we're focusing on driving cash flow. Eventually, the market buys cash flow. It buys cash flow. So if you have upward trending cash flow, you have a well cared for asset, there will eventually be a buyer.
I'm going to keep picking on you. I don't know why. It's kind of fun right now. Can you, as a private equity, and Amin from Starwood was talking about this in the future C-suite, that they're constantly debating, can you, as a good fund, as a steward for your LPs, can you sit on capital for a year or two without deploying it? I know you've never done that. I understand that. But
yeah, I mean,
how much pressure do you have? That's what I'm trying to get at.
I think it's a good question. I think that's where the fund managers and the companies have to be disciplined on how much money they take. We're in a totally different league than Blackstone. We're a deal. Our $450 million fund is a deal for those groups, and so we've tried to size our capital with our ability to deploy capital in the same way that we've created value over 25 years of doing business. So, what I would say is that you got to be patient. The only way to outperform the market is to be selective, and so how you can be selective in the market will dictate in whatever size of your company you are, you can deploy that capital with that size. So I would say investors, depending on who your investors are too, and I'll end with this, transparency and close relationships with your investors is critical to address that issue. They don't want you to make dumb decisions. They don't want you to push money out to do deals. They want you to be smart. but they also want to get a return on their investment if they made a commitment to you. Now, keep in mind, when they make a commitment, we're not drawing the capital until we have the need for it. But at the same time, they're allocating capital to different places, and they're going to allocate capital where they can get it deployed.
Greg, same question, although it sounds like you were doing it in credit. You answered it earlier, doing credit and buying notes, but same question.
Yeah, I mean, there's no question there's always pressure to invest capital, but the quickest way to get out of business is to start deploying capital in bad deals. And the environment, if you're trying to make equity investments over the last 18 months or so, it's been really tough. And I think most LPs, most investors don't want you to go invest, capital in something that doesn't make sense, where you're buying stuff that in a lot of cases, you have negative leverage, or, values haven't fully reset to the new normal. And on the flip side, the credit side, I would say, there's a lot more interest from investors to invest through credit, because there's so much more opportunity there where you can invest at lower leverage points. You can effectively attach at, pretty protected positions and drive returns that are, very similar to what you could get through the equity side. And that's why we've been very focused, on that side of the trade.
So you can tell these guys are smart, and from the intermediary broker standpoint, I'm coming to you guys. I don't like it, because they're calm and doing math. And in my world, deals don't get done when you do math. I need pure, unabated emotion. You just have to have it for one reason or another, and that's how we get the deal done.
Yeah.
Anyway, Al, what are you spending all your time on?
So we're still developing hotels. It's very difficult now as opposed to the last couple years, but we've got probably 9 or 10 under construction right now.
That's great.
In various parts of the country. We typically focus those developments on either markets that we think are high growth markets, or we think are higher barriers to entry, of course. And we've done some acquisitions the last 6 months or so, probably half a dozen or so hotels acquired, and probably be like another half a dozen or so by the end of the year.
I'm gonna ask Mitch same question, because I think you guys are gonna answer it the same way. So I'm gonna ask you both. Same thing. What are you spending your time on?
Before I answer that,
Oh, boy.
I want to take this moment to
Oh, boy.
congratulate you, Lee, Bob, on 35 years of this conference. Let's give them a big round of applause. I could honestly say this, that we would not be the company that we are today if it wasn't for this conference. The relationships that we built over the years and knowledge that we gained from the breakout sessions to this is invaluable. I know there's a lot of young people in the audience. The question that was asked the previous panel, what advice would you give them to start this business? This is the number one advice that I could give you, is come to places like this and learn from so many smart people that are in the room that have done it. So every company creates value differently. You've heard that from the Wall Street panel. You're hearing it from our Main Street panel. We have historically created value through development, right? So it's 27 years, first hotel, developed it as a contractor, and then I was a general manager, so learned every aspect of this business. So today, we have 14 hotels in our pipeline. Of those, 6 are under construction. But I will have to tell you, Teague, that this is probably the most challenging time that I have probably ever seen in development. We were hoping, when the pandemic hit, that construction costs would go down, right? But of course, with the tremendous amount of stimulus money that was out there, inflation took over, and that impacted every aspect of what we were doing. And the labor shortages compounded it. So we are still in a very challenging environment for construction. So it's if you're okay with barely double-digit leverage returns, then, and if you're a long-term holder like we are, I'll tell you, every project that we have done, I'm always battling with the budget, even 15 years ago, 20 years ago, to even today. But every project that we have developed 5, 10 years from now, we have been satisfied with the development cost that we were in, right? So this business is, at the end of the day, about basis. And I guess it's like wine. You might not be thrilled right at the on-go in year one, but after 5 or 7, 10 years, it might taste a little bit better.
Al, add on to this. Why is it so hard to develop? I was at dinner last night. I won't name the names, but Todd Turner at OTO. And he said that, Todd, correct me when I'm wrong here, but they don't have anything on their development pipeline for the first time in their career history of their company, 30 years. They have 0 in the pipeline. Why is it so hard to develop today?
You know, it's incredible. When we first started in this business, whatever it was, 25 years ago, we built our first hotel, and, the returns were like in the 30s.
Yeah.
And then they went down to the 20s, and then the high teens, and then the mid-teens, and now, like Mitch alluded to, now we're in the low teens, and yet we still keep doing it. And, development's hard for many reasons. Obviously, you need a lender partner, first and foremost. A lot of the bigger banks or the regional banks that we were used to dealing with have now merged with other lenders and things like that, and now our business is of no good to them anymore. So now we're having to find smaller banks. Sometimes they need a participant to do the loan. Maybe you can find the first bank, but the second piece becomes troublesome. So, our guys are mostly focused on debt. I mean, sites and acquisitions and projects we can find easier than we can find debt, which was the opposite. 5, 7 years ago, we could find the debt, but we had trouble placing projects for that debt. So those are some of the reasons. The general contractors, it's, in the Mountain West, we're having difficulty even finding a contractor that'll take the work. They're so busy. So that's become a problem. Subs, there's always one, before it's like every third or fourth project you'd have one sub that was terrible. Now it's like every project has one sub that we need to boot off. And then the next one comes in, probably costs a little bit more and whatnot. So, you've got all those difficulties to deal with. And even when among the labor, prices seem to keep going up. We were leveled off a little bit as of late, post-pandemic. But I also think, those costs add up. And, the brands, there are certain expenses associated with those. Most brands, you need to hire a designer now. The designer is backed up. And, all in all, all of that combined, FF&E, supply chain issues, and all of those things. It took us 6 months to get some case goods for Residence Inn recently. It's just, it's getting out of control now. And all those things combined are causing some headaches in the development side and causing the prices to go up.
Mitch, anything to add?
Pardon?
Anything to add?
No, I mean, Al said it well. I mean, it's very challenging. I would love, though, every industry has been disrupted. The construction industry needs to be disrupted. And so we've been talking about modular construction for 25, 30 years, and no one has quite been able to figure that out. And I think that, there's so many benefits in going with modular construction. Labor, huge labor challenges in the construction industry. I believe that we're doing more work today, more construction work is happening in this country than 20 years ago with like 50, 60% less construction workers. The average age of a construction worker is approaching like 45, 50 years old, and young people are not wanting to come into this industry. So it needs to be disrupted, and we are talking, it's looking promising, but we are talking to some companies that I think are figuring it out. And as Al said, the cost have gone up so much, right? When it was $100 a square foot, 15 years ago, 18 years ago, to stick frame construction, you're looking at $190, $200 a square foot, block and plank, even more than that. In a tertiary, secondary market, it's very challenging. That I think that we're finally starting to close that gap. And then, of course, we talked about the interest rate environment, right? Our construction interest costs have more than doubled, as well as other costs in design and FF&E and so forth. But when you could reduce that timeline, we used to build hotels for 12 months. That same hotel is taking 18 months to 2 years. So now You compound that with today's interest rate environment, it becomes very challenging. With modular, I've heard that you could get this built within 4 to 6 months even. So we're going to put a lot of effort into figuring that out because like I started off with, we're developers and the supply, demand metrics are in our favor. You've heard that in the last 2 panels. Supply has grown 2% annually last 30, 40 years. I don't think it has grown more than 2% from 11, 12 to 2020, right? It was finally hitting 2% in 2020. And then, of course, the pandemic hit, and that derailed that. And going forward in the next 5 or 7 years, we're talking about 1 to 1.5% growth on supply. And you heard earlier with demand is going to follow GDP. And hopefully we'll see a 2+% growth in demand over the next 5, 7 years. So it bodes very well for all of us in this industry. If you have an existing portfolio or if you're a developer like us that are trying to get hotels open.
I mean, the construction guys in the room 90 seconds ago hated you, and now they love you again. Hey, this is great.
They could still build this with modular, right? As a subcontractor, there's still so much that's involved in with the contract.
So, if you're developing? What are you building and where?
Sure. So we want to stay in the select service space, right? We talked about the labor challenges and operations as well. It's a space that we know very well. We've strayed into the luxury boutique hotel space with soft branding. We've done well with that, but we like this firmly. We want to be in this select service space. And so select service lifestyle is a space that we really like. We want to differentiate ourselves from the competition. In many of these secondary markets, there might not be a hotel that is similar to a lifestyle hotel. And then of course, extended stay. It's been the darling of the industry. Those are probably our best performing hotels in the last 5, 6 years. And so we're going to double down on the extended stay segment as well.
Al, same question. What are you building and
Yeah,
where?
so we typically, we love extended stay. It's probably 80% of our pipeline, about 65% of our portfolio, something like that. And we're also dabbling in the kind of the lifestyle select service space with both Hilton and Marriott. And we like those brands. The rates seem to be really strong and the flow through is good.
Are you doing any of the economy extended stays that have been announced?
So we've signed some up. We'll see how it goes. We're going to start our first one very soon. We're still a little apprehensive to see how that all works out. With today the rate of the game is rate. The name of the game is rate, and so with these, we don't know how that rate's going to work out. We understand the 10 FTEs and things like that, and the flow through comes from ADRs, and if that ADR is going to be in the 90s or whatever it is, then we'll have to just see. Like we've done with all the other brands, we'll dip our foot into the pool a little bit, see how it goes, and then if it goes well, then we'll accelerate that side of our business.
Y'all like worry about just the saturation of like that product type?
Yeah, so
between all
that's a
the
great
brands,
question. So we
rolling it
got
out
into
at
the
same time?
extended stay business because Hilton had 2 brands basically. Marriott had 2, and they acquired 1, which was the Element. So basically you could do only 5 of those brands at any street corner. But Marriott has 30 other brands that they could have done, and Hilton has whatever 22 others. And so at least you could differentiate yourself within the select service space on any given street corner. Now you have the proliferation of these brands, Hilton, Marriott, Hyatt, and then still bring in Wyndham with their brands and all that, and those are still going to be developed. And so we're extremely concerned about the supply growth in that particular segment. And you're going to be brand new, right? So
Yeah.
they might take a little cherry pick from ours because they're going to be brand new.
Yeah, it's almost, because it's sort of interesting, like I feel like everyone's going after that segment right now on the extended stay side.
Yeah.
It almost feels better to go develop just transient hotels. I mean, don't get me wrong, I love Residence Inns and
Yeah.
Homewoods, but then, with all these new, budget extended stay brands, you almost wonder, is there just way too much supply coming at the same time, and is the better opportunity set to go after, the traditional select service, the limited service, the lifestyle type hotels have done well. like the Marriott ACs and the, Courtyards and Hilton Garden Inns and so forth.
Yeah, leave it to the brands to kill something that's good.
Right.
Well, I think a little bit of the reason why that's happening is the size of the deals, right? The size of the deals can get financed. And, the shorter construction period, all of that. So one of the things, Mitch, I would love to see 4 to 5 month build periods. That would be amazing. I think that one of the challenges that I wanted just to, continue to amplify is you can't underestimate the challenge of the banking industry right now. I mean, they are, there's nowhere for the loans to go. That's why Greg and we're doing loans. There needs to be a home. They need to get paid off when they don't have the 10 plus debt yields. And the banks and a lot of the banks that fund our industry are these community and regional banks and super regionals. They're over allocated to real estate, and they're getting scrutinized by the regulators, and it costs a lot for them to have a impaired loan on their balance sheet. And this has to get solved before you're going to start to see more construction lending. I always joke that there's not a banker out there that wakes up and let's go do a hotel construction loan today. They want cash flow. They want, and now it's just especially hard to get that loan, and it's going to put constraints. No matter what's been announced or what people have land that they bought, it's going to put constraints to supply. Supply is going to be slower to hit the market, and ultimately, this is a growth business. You just look at it over the 45 years, of data, and you see the inflection points. But revenues are higher today. If you put the mean, the line is a 45-degree angle. If you do good deals and good locations over time, you're going to create value, and that's why developers develop. They're smart. They pick the right sites. They build it the right way. They operate them well, and they might not hit the market right, and they're well capitalized. You survive through a downturn, you're going to create value in this industry, and it's a little bit of what we've done is try to be really well capitalized, do smart deals in the right locations, and when you hit a tough period of time, survive with your assets, continue to take care of them, but then be really opportunistic when the opportunities come, and they will. And you hear it, This is new, what Greg just said, and what Mitt said, buying debt, last year it didn't happen, now it's happening. That's an interesting sign and something everybody should pay attention to.
Yeah, and I think to your point, the banks are just, I hate to say it, the model is broken right now, and the regulatory pressure is not going away, anytime soon. So I think you're entering a new phase of just credit and lending where you're gonna need other sources of capital to sort of, bridge or take over from the, portion that, traditional banks are gonna, the void that they're leaving behind through all this, because regional banks, community banks make up 70 to 80% of the commercial real estate lending market in general, and a lot of that's hotels. And you're gonna continue to see consolidation across banking. You're gonna continue to see just the lack of interest in doing lending unless you're gonna be putting a lot of huge deposits in different banks. So,
Greg, put your lending cap on. What kind of loans are you guys making? How much? Where you make? What kind of projects?
yeah, so we're financing mostly select service, extended stay type hotels. We're doing smaller full service hotels. Typically branded projects, $20 to $50 million in size is typically the loan size we're doing, and usually providing like 60 to 75% financing on the total acquisition costs, development costs. I would, 40% of what we're doing on the lending side today is actually construction financing, just given there's a lack of capital there, and we do a lot of just recaps, refinances, or even just acquisition financing today. So,
Jimmy, how about you guys?
I was going to ask Greg, what do you see as your sweet spot? How would you price that today? compared to a bank?
Yeah, so I would say construction is, we have a huge advantage on just because, most banks aren't willing to do construction, or if they are, they're doing it at 50%. Usually we're going 65, 70%. And then I would also argue that our biggest advantage is really financing transitional projects where someone's buying an asset that's under cash flowing to where they think it's going to end up at, where we can come in and provide that bridge financing for 2 to 3 years. And usually, we're pricing at like SOFR plus 500 to 600 over type pricing. So, on that type of product.
And you guys are doing mostly regional banks.
That's right.
Yeah. Are we in a good spot or a bad spot as an industry? Greg, you bullish or bearish?
I'm bullish just on the industry itself long term. I think, unfortunately, I'm sort of bearish just on the economy right now with everything happening and with us having to deal with the impact of just higher rates. We went through the last decade where the treasury rate, the 10-year treasury rate was closer to 2%. Today, it's north of 4%. And I think we've just entered a higher interest rate environment that's just going to continue to put pressure just on values for all of commercial real estate, hotels included. So I'm a little bit bearish just on equity in general.
What happens when rates stay higher longer?
I think it's just the market recalibrates from a standpoint that you're going to see cap rates continue to expand out. I think hotels are less impacted. Fortunately, we're not, multifamily, which has had, huge or had bigger cap rate expansion, but we're still, we still have that same risk of further expansion if, interest rates truly stay higher for longer. So,
Al, what do you think?
So I'm bullish on the industry and the fundamentals about the industry. So we've got very low supply growth. Demand seems to be increasing a little bit. We had a nice bump up in ADR with the pandemic inflation, but now consumers are pushing back a little bit. So we're not seeing the high rate, the ADR increases that we used to. But behind it, we're seeing a lot of the inflationary things now catch up to us. Labor, insurance has been mentioned very much so, especially in the markets that we operate in, and is anything with wind and hurricane kind of exposure. So those insurance rates are doubling, sometimes even tripling, which causes issues. Much of our portfolio is fairly new, so we'd be able to mitigate some of that. But if we're acquiring an asset that's 15, 20 years old, we're paying probably 35, 40% more on an insurance premium. If we have a hotel right next door that was brand new, it's 30% less. So, those are the kinds of issues that we're concerned about, especially the ADR increases that we don't see happening in the near future to be helping to catch up with inflation.
Mitch?
Yeah, look, 70% of our economy is on consumer spending, right? And consumer confidence drives consumer spending. And consumer confidence is usually dictated by the market, so household balance sheets, the market, home equity values, so up, and job security. Looks good. So I think that is driving our economy the last couple of years, driving our business last couple of years, but I'm starting to see it slow. And so, you heard this earlier, the economy segment, their household balance sheets don't quite look like that, right? The stimulus money, tremendous amount of stimulus money that was in people's hands have waned. You're seeing credit card debt, 40-something% of Americans have credit card debt. They're paying 24, 25% plus interest rates. So that's weighing in quite a bit on travel demand, and you're starting to see it starting to break a little bit. So that's what I'm a little bit concerned about. But your luxury, it's still going extremely well, but we're not in that segment. We're in that mid-scale, upper mid-scale segment. And so we're going to see that we have seen a trend. 1 month doesn't make a trend, but 4 months, you could say that's a trend now. So we're seeing 4 months of decline in our portfolio, the last 4 months, that is. And we saw it last year, too. The first quarter was gangbusters. You're comparing it to a pretty poor quarter in 22, though. Let's keep that in mind. But every quarter, we're seeing year over year, starting to see that taper, and we're seeing that this first quarter as well in 24. So it's going to be interesting to see. I mean, we're focusing on the fundamentals. This is a We talk about this all the time. It's a real estate business with a service business component that's layered on it. That doesn't get talked about often. We're talking about the investments and cap rates and costs and so forth. But go into Marriott.com and type in Atlanta, and you'll see about 50, 60 Marriott properties that will pop up, this one included. And there's a rating next to each one. And that just reminds you that this is a transparent business, it's a service business, it's a people business, and I can't tell you that there is enough that there is a correlation between how you run your hotels and how it ultimately performs, right? So the hotels that are 4.8 on that on the website is going to command probably greater rates, greater market share, and hopefully greater profitability. So that's what we're focusing on. We're an operating company, we're a developer, obviously as well, but we've got a great team, and we're focusing on what we can control and not worry too much about what we can't control, and that is gaining market share through operating our hotels better.
What are you guys seeing across your portfolio? He says he's down 4 months in a row. Al, what are you seeing?
Sorry, what was that?
What do you see in RevPAR in your across your portfolio?
In the 110s to 120s.
Is it down 4 months in a row, like Mitch just said?
Some are. It's been market specific. Florida's down.
Right.
For example, we had such a strong year last year, so we're coming off that. But some spots in Florida have held up very well, despite that. Tampa's been a little soft, but a little bit of the hurricane effect from 2022 was very strong. And October 22, I believe the hurricane hit in Fort Myers, so it was strong. So we're seeing different mixed bags. The Northeast has done better. The Mid-Atlantic Northeast has done better because some offices are coming back a little bit, and we were in a lot of corporate markets. They couldn't go down any further than they already were, so that we're seeing some improvement in those markets.
Yeah, and it's sort of interesting just because we're seeing something similar to what Al's talking about. It's just a lot of volatility and choppiness based on submarkets, where, what locations you are across the U.S. Like certain markets that have taken longer to recover, you're actually seeing, you're seeing some positive growth on RevPAR, and then other markets like South Florida, we're getting, hit pretty hard, but, it's really, when you look at what you're, the downward trend right now, you're really still above where you were pre-pandemic, and a lot of this is just, inflated demand that occurred during COVID as well. So, some factors like that, but on the flip side, it's concerning because, to Mitch's point earlier, the consumer drives so much economic activity. If the consumer starts to really get soft, then this, we're probably in for a much harder landing than if the consumer continues to stay, resilient as they have over the last year or so.
Jimmy, what are cap rates today?
Cap rates?
Cap rates.
What's a cap rate?
Yeah, good point.
When we buy properties from you, there's it's negative. All emotion.
No, it's
all
a 12
emotion.
cap, if
Yeah,
you're operating, right? Like, that's-
exactly.
You guys are looking at the same deals. Good.
We're trying to get there. So just to amplify what was said, we're bullish. You have to be in this business, and it does reward those that are thoughtful and intentional about the things that they do, and that both on the physical real estate, but what Mitch said about operations and being really thoughtful, and duration matters. And if you're you could 10, 15 years ago get into an asset, swing in, flip the hotel. It's very hard to do that. So we've always said we're not market timers. It's a bad business. It's not a replicable business to be a market timer. And no matter what market you're in, but if you're a deal timer, that's what matters. And this goes across the Warren Buffetts of and all the you name the investor. It's about the deal and focusing on the things that you do, not the things you don't do. And so we're bullish on that in this business. And but I would say 23 was one of the hardest years that we've experienced, just when you look at the after effects of COVID and delays of renovations that you're doing and that impact. Then you have the interest rates go up 550 basis, SOFR goes up 550 basis points, and then the banking crisis on top of that. And you don't have loan terms that, match your deal horizon. It made it a bit of a grind last year. But, I think if you've been in the business, like all of us up here have been, it creates opportunities, and just making sure you continue to get better at your craft and do the things that you know how to make money. And everybody up here has learned what they're good at and how to make money.
Mitch, we have 5 minutes left, and at the risk of having you get on a soapbox and take us in a different direction, how big of a problem is the PIPs in our world today?
I think it's a huge problem, and I've said this many times, 4% capital reserve isn't sufficient. And then on top of that, we all know what happened 4 years ago and how those reserves were depleted. And so there are thousands and thousands of hotels that are due for renovation or due for PIPs. And so I think it's a huge problem. I think that's going to put a lot of pressure on owners of these assets to potentially have to sell. They were dependent on the refinancing to take place to have the capital to do those renovations in the past. That might be much more challenging now going forward. But we've done a lot of construction, mini-perm lending. We've never had a lender make us put a reserve in place. On a refi they have. And I know a lot of my friends, they're entrepreneurs, they're developers, and they're wheeling and dealing, and they're not putting those funds aside. And I will tell you, we have many hotels that we renovated just this past winter. It has doubled over the last 5-6 years, the same scope of work. And so it is, going to be a huge challenge to come up with that kind of capital to keep that property. And as a developer, newer is always better. And when you open new hotels in a marketplace where there are hotels that haven't been renovated in 12, 15 years, it gives you a little competitive advantage. But I think that is going to be a huge challenge going forward with renovations.
But if you're a hotel broker, you're pretty excited right now because you've got a huge amount of CapEx spend that needs to occur. That's going to be a catalyst to cause groups to have to trade assets, not to mention all the challenges on the debt side. So
Well said,
Teague should be
Greg.
the
Well
happiest
said.
person up here.
Well
How
said.
many times has Teague's projected PIP been more than you've actually needed to spend?
Never. It's like 50%.
It's part of the game, guys. You guys understand that.
Right.
That is part of the bid-ask spread, though, right? It's when you add the PIP in, it's a 7 cap all in to the buyer and a 9 cap to the seller, and that sort of becomes a no deal, right? Because the PIP is that much.
Displaced revenue, right? So during the PIP process, you're displacing revenue. They might go try out the other hotel down the street. They were loyal to you. Now they're trying it out. They might like it there, and they might not come back. So all of that, there's another ramp-up period post-PIP also. I tried to save you there, Teague, on that line of questioning. But yes, so those are the issues that you've got to deal with too when doing a PIP. It's not just getting it done, because now it takes longer. First we just get a PIP done in 6-7 months. Now it's probably taking a full year. Some of the stuff doesn't come in. Operations gets frustrated. It's a very challenging environment.
Which is why we recommend to our sellers, don't do the PIP and leave it for the next guy.
Right.
Right. Is that wrong? Felt like good advice.
That's probably not bad advice.
That can't be terrible, right?
You can sleep at night.
I can sleep at night. I'm wrapping up here, so thank you guys. Please thank these guys. Mitch, I'm chuckling to myself because you're interviewing Tony Capuano, CEO of Marriott, tomorrow, and I'm dying to know if you're going to ask him any of these questions.
Absolutely.
And conversely, Greg, if you're interviewing Ed Bastian, CEO. So is there a comment section box we can all drop our notes in about our complaints on our Delta
Sure,
travel?
there'll be one in the back,
And
right?
you'd be sure to ask him personally?
Yeah, sure, why not, right?
Well,
Or how do you just become Delta 360, right?
How do we become
Yeah.
Delta 360? Diamond's not enough anymore.
Exactly.
I need to be 360.
Yep.
Thank you all. There's a Wyndham reception downstairs starting now, I think. Thank you, thank you, thank you. Great day one. Thank you.
Yeah.